All right, welcome everybody to the latest Advance Your Wealth video and podcast. This week, I'm going to be talking with Corey Hoffstein, co-founder and CIO of Newfound Research. We're going to continue discussing this theme that we've been digging into over the last couple of months around the idea of this death of the 60-40 portfolio. So welcome to the show, Corey. For the audience, maybe just give us some background on yourself, how you got into the portfolio management space, and kind of how your philosophy has evolved over time from your experience.
I'm excited to be here. Thank you for having me. So I got started right in the 2008 crisis. I originally went to school at Cornell University for computer science, pretty quickly realized I didn't want to do that for a living. And at that time, pre-2008, when I was in undergrad, it was a very popular career track for people to start looking into investment banking and sales and trading. And I got really interested in the idea of applying quantitative methodologies to investing in the market. Ended up going to graduate school at Carnegie Mellon for their Masters of Computational Finance program, which is sort of an advanced degree in financial engineering and derivatives pricing and portfolio construction. But was fortunate at the time that I had this research company called Newfound Research that I was licensing data from to other asset managers that was starting to grow. And so instead of going the traditional track of going to Wall Street and working on a sales and trading desk, I decided to take a little bit of an entrepreneurial venture. And 12 years later, things still seem to be working out all right for us. We did sort of make a little bit of a pivot from a research company that would sell other people our quantitative signals to taking those signals and building portfolios ourselves. But the core philosophy of what we preach has never really changed. Our view is that investors should really focus on proactively navigating the different risks that the market throws at them. And the best way to do that is actually with diversification. The big caveat is that diversification doesn't just mean what you invest in. It's much more holistic. It's also how you make those investment decisions and even when you make those investment decisions. And we think sort of making that more three-dimensional view of diversification helps clients develop much more resilient and robust portfolios.
Great. I first found you on Twitter. I've been figuring out that world over these last number of years and how to use that. But what really hit me as I found you was you did a post in an article or blog post on just your learnings in 2020 and kind of how you had to change your thought process around your portfolio management. And that really hit me because I think we experienced a lot of that same thing at Conversion, and it's made a big difference in how we're approaching things going forward. But where I really got into some of your work was actually from an introduction from Jason Buck. I was writing my own article on this idea of the death of the 60-40 portfolio. And he sent me a research piece he did on this myth that falling interest rates over the last 40 years have been one of the biggest contributors to why bonds have done so well. And I'd always heard from various sources that it's falling interest rates have been the catalyst for this bond bull market. So maybe before we jump into some other things, maybe you give me your thoughts overall on this idea of the death of the 60-40 portfolio and this myth that it's been falling interest rates that have been the biggest contributor to this bond bull market we've seen.
Well, I remember right after 2008, there was a big call for the death of the 60-40 portfolio. And I think the last decade has seen the highest risk-adjusted returns for a 60 portfolio ever in the history of US markets. So I think the path to calling tops is unfortunately littered with graves.
Yep.
The reality, though, is to your point, bonds are a very important part of that 60-40 portfolio. They comprise 40% of the assets, and they've been historically used as a return generator, income generator, volatility ballast. And even in a crisis, we've seen in the last several crises, they've been able to offset equity losses. So a really important part of that 60-40, that negative correlation. To your point, a lot of people believe that bonds have done so well, that there's been this bond bull market because we've had declining interest rates. And if you actually go and do the math, and figure out how have bond returns been generated over time. As it turns out, the vast majority of the returns, not just the majority, but the vast majority, has just come from the yield. In other words, if you buy a bond today, you can be pretty sure of the return you're going to get from that bond just based on the yield you bought it at. And so when you're talking about a bond index or a bond fund, it's a little bit more complicated than that. But if you consider sort of a total bond market portfolio that's going to buy every bond that's issued and hold it all the way through maturity, well, if you know the yield you bought the bond at and you're holding it all the way to maturity, well, it would make sense that yes, there's going to be valuation fluctuations along the way, but that starting yield you bought it at is going to be the primary driver of the returns. So as it turns out, if you're looking at something really simple like US Treasuries, you can just sort of look at the starting yield of the portfolio, and that's a really good estimate of annualized returns over the next 5 or 10 years. So when we go back to the 60-40 and go back to 2008 and say, well, we had bond returns and yields that were, between that 3 to 5% range, that's still an attractive return for a lot of people. 3, 4, 5% annualized over the next decade, a lot of people would take that. Today, even though we've seen 10-year treasury rates climb sharply, they're still sub 2%. So if we say 1.5% today is the 10-year rate, and we start subtracting out inflation, which we might expect to be around 2%, now your real return after inflation on that 40 of your 60-40 has now turned negative. And so the big question is, I'm not here to say that we shouldn't be allocating to bonds. I think bonds still make a great diversifier. But when we look at the 60-40, is there a big built-in opportunity cost now in allocating to bonds as the ballast of the portfolio?
Yeah, I think that's a interesting segue into, I think, one of the most important papers I've read in the last 5 years that you wrote called Liquidity Cascades, and really going deeper on all of the issues and changes that you're seeing kind of in the undercurrents of the economy and the market that's potentially going to drive some potential changes in how things happen over the coming years. And it's something that I think we've been seeing ourselves here internally about just things are a little bit different in terms of what's driving price changes than maybe the past. So I've really enjoyed diving into that paper and getting to know your work better. So, as simple as you can, maybe give us the core thesis of that paper and kind of what's driving your thoughts on the changing environment you're seeing.
The core thesis of the paper is that markets seem to be pretty weird right now, for lack of a better phrase. I think a lot of people have noticed over the last couple of years, markets seem to be behaving a little bit abnormally. They're showing these extremes to the upside where you get these really fast runs, or you get these really abnormal situations. I think GameStop, what's happened recently with that stock, is a really good example. And then you get some really abnormal behavior to the downside. So for example, March 2020, why'd you get such a violent sell-off? Or December 2018, why was there such a violent sell-off and then a strong rebound? The market is always changing. I think the core question we have to ask is it changing in a way that we have to now change the way we invest? And so that's really what the Liquidity Cascades paper was all about exploring. We're sort of noticing qualitatively and both quantitatively that the behavior of the market's different, but what are the fundamental underlying reasons? And so the paper explores a few narratives. Sort of the influence of central banks moving from referee to very active player. I think in this market crisis, we saw a huge fiscal impulse as well, which is very different than what we saw in the prior crises. The growth of passive investing, so migration from active mutual funds to passive investment vehicles. This includes things like the huge growth of retirement vehicles. So we've seen target date funds, for example, go from a $5 billion industry in the early 2000s to now a multi-trillion-dollar industry. What does it mean when people put their savings into the market from how they sort of react to market gyrations? And what does it mean when it's really on autopilot? The last piece of the paper explored sort of this idea of liquidity mismatch. And what I mean by that is a healthy market economy, a healthy exchange would have buyers and sellers. And what we're seeing today is that a lot of the trading volume that's going on is going on with just a few very concentrated market makers. Well, what happens if those market makers all disappear? They all pull the plug and decide they don't want to trade anymore during a period where there's a whole group of parties that all of a sudden do want to trade. And we saw this in March, that there were all these active players in the market that have strategies that try to de-risk into a crisis, all trying to get out of the market at the same time. And it was sort of like everyone rushing for a very crowded exit that caused the market to spiral outward. And so each of these narratives, when I researched it, suggested that it was the answer. To spoil the conclusion of the paper, what I ultimately said was, I think they all work in concert. I don't think any one of these is really sufficient to drive this abnormal behavior we're seeing. But if you think of them all in sort of a big loop, that the Fed and through monetary policy and the governments through fiscal policy are forcing investors to take more risk, that those investors are expressing their investment preferences through more passive structures, that demand for greater market efficiency is driving sort of this reduction in market liquidity with market makers, and a lot more investors are demanding protection as they're investing in riskier assets. Well, all of that works together to just create a little bit more chaos that can unfold to both the downside and the upside. And it's leading to weirder and weirder market behavior that we don't think is going to stop anytime in the short term.
And I think one of the most interesting graphics and maybe shocking graphics in there was the idea of the level of return that you could generate from bonds and kind of how it could fit into a portfolio to get to a reasonable rate of return. Can you describe kind of what you've seen and what you've had to have in terms of a level of risk you're needing to take to generate a similar level of expected return inside of a portfolio, and what that maybe is doing to the impact on all of this as well?
Yeah, the graphic in the paper talks about what sort of portfolio would you need to own to achieve a 7.5% return, or at least expect to achieve that over the long run. And what's really interesting is if you go back to 1995, that type of return was achievable solely owning government bonds, very safe US Treasuries. Fast forward to 2005, you needed a portfolio that was more heavily allocated to equities. So probably a mix around 50-50 stocks and bonds. Today, to achieve the same expected 7.5% return, you need something that is probably 90% equity-like asset classes. And a lot of that's going to be very illiquid, that you're going to have to invest in real estate investment trusts and private equity and private credit, so that when there is a crisis, a lot of your money is going to be tied up in a way that you're not going to have access to it. And so it seems like an arbitrary decision, right? This 7.5%, but it's really relevant to a lot of institutional players, endowments and pensions who have these really far dated liabilities, right? They've made promises to either the university that the endowment is tied to, or the pensioners that they have to pay off in 20 or 30 years. And so they have to build portfolios that target these returns. They can't just spend less or save more. They have to sort of take on this risk. And what it means is that you have all these very large institutions, and I would personally argue this is happening to retirees as well, that are having to move up the risk curve. They're sort of walking out along the plank to take further and further and further risk, crossing their fingers that things don't go wrong because they really don't have another choice.
Yeah, it's a scary proposition. One, to your point, that we deal with every day with our clients, and how much risk they should be taking, and kind of being forced right now to in some cases take more risk to generate that reasonable return. One other area in the paper, you touched on it already, was passive investing. And most people, when they think about passive versus active management, they're thinking of it in terms of performance and cost. And that, over the last number of years, passive investing has done as well or better than most active managers, and for a lot lower cost. And so there's a big push towards passive. But your thesis in the paper isn't so much around that. It's around the flows and what that is doing. So I know you touched on it already, but can you maybe just specifically dive into that? Because I think when people hear passive, they're thinking kind of that initial argument that I described. But what is it really that you're seeing and others are pointing out around the issues potentially with so many flows going into passive investments?
When we think about passive investing, the word passive sort of has its own connotation, right? You are in theory, allocating to the market in a way that you're taking your hands off the wheel and saying, I'm going to let the market sort of dictate the prices. I'm just going to buy the entire market and let all these active investors sort of sort out what companies are worth. Obviously, that would break down if active investors were no longer in control. The problem, what we're starting to see and potentially seeing edges of, is passive isn't all that passive. If I put $1 in the market and then never do anything, yeah, that dollar is going to trade passively. But we commented a little bit before about, well, we have now all these sort of target date funds, and people are constantly contributing to the market. And the difference becomes, how does this story change when we consider that there's new money flowing into the market all the time into these passive funds? And so let me sort of explain why that distinction is important. So let's say I buy a passive fund today, and I buy a passive equity fund, and it's going to have allocations to the top 500 stocks in the market, allocated in proportion to their total market cap. So the bigger companies are a bigger piece of my portfolio, the smaller companies are a smaller piece. Those weights are going to drift relative to each other based upon how well those companies perform. Companies whose price goes up more than other companies are going to see their weight in the index go up. Again, for me, totally passive. But let's say now you come tomorrow and you buy $1 of the same portfolio. Well, the weights which you've bought are different than the weights I bought. They're equal to the weights my portfolio sort of drifted to, but you're now buying more of the stuff that's gone up and less of the stuff that's gone down. And let's say someone comes in tomorrow and does the same thing. Again, they're going to buy more of the stuff that's gone up and less of the stuff that's gone down. And so the big sort of unanswered question right now is, as passive goes from 20 to 30 to 50 to 60% market share, is there a risk that that continuous flow is driving a wedge between the winners and the losers? That does that continuous flow into passive mean that stocks that are relatively outperforming will continue to keep beating other stocks, and it's no longer going to be connected to fundamentals the way it at least should be in theory?
So given that, and I know that's just one component of your liquidity cascades theory, how has that changed what you're doing within the funds that you manage and your strategy to kind of counterbalance the things that you're seeing?
The bigger liquidity cascades theory, sort of getting rid of the underlying reasons, is, again, for lack of a better phrase, the market is weird. It's going to keep being weird, and it's going to be weird with sort of things offshooting to the upside and the downside. We're going to see less of the middle, more of the extremes with greater frequency. And so for us at Newfound, we've always taken this proactive risk management approach and have historically done it very tactically, deciding when we should allocate to stocks versus bonds, for example, based on different quantitative signals. As the market starts to move faster, that becomes like an increasingly fast game of whack-a-mole.
Yeah.
And it no longer really makes sense. And so what we did is we went back to the drawing board and said, well, we think the extremes are happening with greater frequency. We think risk management is more important today than ever before. And by the way, I think risk management means both making sure you protect on the downside and participate on the upside. That participation is really key. How can we rethink our portfolio design? And so what we said was, what we need to do is go back to that core concept of diversification and think about other ways in which we can include diversifiers. And so what we did is we built this barbell portfolio. Part of the portfolio is designed to do really well in strong bull markets, and part of the portfolio is designed to do really well in bear markets. And the idea is that the blend between them should give you a balance. But hopefully in those strong bull markets, the bull piece is going to outperform the bear piece. And in those bear markets, the bear piece is going to outperform the bull piece in a way that we are participating and protecting in the extremes with this barbell construction.
And so one of the concepts we've been talking to clients a lot about lately is this idea of long volatility. It's not an easy concept to describe. And then, this other idea of short volatility, and you're kind of one or the other. So in your terms, what does long volatility mean, and how do you incorporate into the portfolio versus the short volatility strategies that might be in there as well?
I think maybe the easiest way to think about it, and it's not perfectly technically accurate, but I think you can either think of yourself as an insurance company or someone who is buying insurance. If you're buying insurance, you're paying a little bit of a premium every single year, but that insurance contract is going to be worth a whole lot of money when chaos ensues, right? So let's say you were able to buy insurance on a flood or a house burning down. Again, you're paying just a little bit of money every year, but when there's that volatility, when there's the house burns down or there's that great flood, that contract is now worth a whole lot of money. You profited in that period of chaos. Conversely, if you're an insurance company, you're selling all these contracts. So you're earning that premium over time, right? So very smooth, consistent earnings until there's chaos, and then you got to pay out. So what you see in the market is this is sort of a more generic classification. Buying stocks, for example, is actually, most people probably wouldn't think of it this way, but probably more akin to being an insurance company. You are buying into this very consistent cash flow at the risk of these companies going bankrupt. Versus if you were to buy put or call options, which are just very simple derivatives, you would actually be long volatility. You would be buying protection on the downside with puts, like an insurance contract, or you could buy some sort of lottery tickets, excess participation on the upside with those call options. And so for us, it's been really important to rethink portfolio construction from a structural perspective and saying, if we think these extremes are going to happen with greater frequency and greater magnitude, don't we want to make sure there's part of our portfolio that is long volatility, that we want sort of extra exposure that can really pay off when markets get weird to the downside, and a little bit of extra exposure that can really pay off when markets get weird to the upside, at the cost of, if markets just stay totally normal, we're going to be paying those premiums and losing a little bit.
So it sounds like, from the way that you're thinking about portfolio construction, is a way that one of the best ways I think I've heard this described is by Diego Pria at Quadriga, which is this idea of fielding an entire team to manage and diversify. So it's not just diversifying between large cap, mid cap, small cap, international, and bonds. Those are all, we'd say, short volatility instruments. They're going to typically converge to one, when everything is chaotic. So maybe in your words, thinking about how you've built your portfolio, you've described it a little bit in terms of a kind of a barbellish strategy. But would you also describe your thinking of, in terms of building that team where you've got offensive strikers, you've got defenders, or I guess in your words, how would you think about that team approach?
I actually really love that team approach analogy. I'll compare and contrast. What we used to do, which was more tactical, was almost like having a team where when we were on offense, the entire team went up to offense. And the risk there was the ball would get kicked over their head and the team had to run back in time to try to play defense.
Yeah.
But if they were all on offense at the same time, well, they were probably an overwhelming force. Conversely, if they were all on defense, it was easier to defend, but the risk was they couldn't get back on offense in time. The new structure we've set up, right? So that was sort of the increasing speed of whack-a-mole, that they had to run back and forth faster and faster. The structure we've sort of set up right now is saying we want our team split more on offense, more on defense permanently, with just a few midfielders. And hopefully the midfielders can sort of help us balance, and they'll run up to play offense when needed, and they'll run back to play defense when needed. But if the ball stays in the middle of the field, they're probably not going to win that part of the game. But we're going to have more people structurally on defense, more people structurally on offense. And you know what? We'll even say we'll pay up a little bit more for better players, right? So that when it does really get on offense, we've got a better chance of capitalizing. When it is on defense, we've got a better chance of protecting. And again, we're going to give up the ball in the middle of the field.
Yeah, so to take that analogy to kind of real life in the portfolio, where will the portfolio really perform well in terms of in theory, and where will it struggle?
Yeah. So in theory, where it should perform very well, again, is a very strong bull market. So if we were to see markets go up 10, 15, 20%, that's where we would expect to see a lot of the securities that we're buying, momentum type names should outperform. We would see our portfolio tilting into more equity beta. And so more exposure. And the call options that we're buying, which we can sort of think of like as lottery tickets, should be exploding in value. So we should do very well in that environment. Conversely, when the market starts to sell off, that's where our portfolio will actually shift to defense. We'll start to sell off a little bit of market exposure, reduce the total amount of equity we have. And the put options we buy, which are like insurance, should also explode in value and help offset some of those losses. Where the portfolio is going to struggle more is going to be when the market's going sideways, because we're constantly going to be paying for those puts and those calls, those lottery tickets and that insurance, and it's going to bleed on the portfolio a little bit. So the more the market just goes sideways and doesn't really move up or down into the extremes, the more that we would expect the portfolio to relatively underperform a more passive allocation.
Got it. Great. Well, I think this has been a lot of great information for me. I'm excited to have our clients and others review this as well and get more educated on your thought process and how you're managing the Newfound Research portfolio. Anything else that you think would be important for people to kind of get out of the Liquidity Cascades paper and thesis, or what you're doing at Newfound?
Well, I will say for me, I think the most important thing is there's no panacea. That when we're building a portfolio, the core philosophy I go by is that risk is never destroyed, it's just transformed. That when we make these different trade-offs in the portfolio, they are trade-offs. And so we want to be very proactive and say that what we're building is designed for the extremes and won't do as well in the middle. That doesn't mean there shouldn't be other parts of the portfolio that might be able to do very well in the middle. And so I think it's really important when thinking about a portfolio as a whole, like the portfolios you would build for your clients, Homer, that you don't go through them line item by line item and try to measure the performance of the individual components. You need to look at the fully baked cake, right? We're not going into a cake and plucking out the individual granules of sugar and saying, "Oh, I don't like this one." We need to think of the total composition together, because ultimately that's what's driving the long-term bulk of growth over the long run.
Great. Well, where can people find you if they haven't already? I know you had a big following on Twitter and you're pretty active there, but so where can, on social media and others, where can they find you?
Yep. They can find our website at thinknewfound.com. They can find my podcast called Flirting with Models. It's a very quantitatively oriented investing podcast. And then finally, they can find me on Twitter at Hoffstein.
And one other thing I'll add to that is you're doing a cool YouTube video series with Jason Buck as well that I think I've gotten a lot of value, where you guys are really going into kind of very relevant topics that are going on out there in the markets and breaking them down, I think, into very bite-sized, understandable chunks. So it's Pirates of Finance, I believe, is the
that is
name.
Right. Yeah, trying to have a little fun with it.
Yeah, so check that out too if you guys get a chance. I think that's a really valuable addition to what Corey's doing. So with that, Corey, really appreciate your time today, and thank you so much for joining me here on Advance Your Wealth, and we'll look forward to talking to our clients more about this here in the near future.
Thank you for having me, Homer.
All right.